If you have over $200,000 sitting stagnant in your bank, retirement account, or home equity, then you're literally losing money. On this show, you learn how to get that money working for you consistently and conservatively. Learn to grow your nest egg with your host, Shawn Winslow. Let's dive in.
Welcome back to another Multifamily Monday episode. I'm your host, Shawn Winslow, and this is the Multifamily Money Podcast. What's going on, everyone? Pleasure to have you all back tuning in to another episode of Multifamily Mondays. This is when every Monday we just dive into all things multifamily real estate investing. And before I get into that today, I know I've mentioned on many episodes recently that I had a competition with myself to get 100 ratings and reviews on Apple Podcasts by the end of this month, by the end of June. And, in May, we had already hit it, and we were at, I believe, 101 ratings and reviews by about, I want to say, mid-May. And I don't know what's going on with Apple. I've heard this from other podcast hosts that they've had this same issue, but we have lost ratings and reviews somehow. So we went originally from 101, and about a week or two later after I announced that, we dropped down to 89. And then I got a few ratings after that, and we were back up into the 90s. And now I just looked before I hit record on this, and we're back to 79. So I'm not really sure what's going on with Apple there. But if you haven't left a rating and review, I would really appreciate it if you would take the time, if you've gotten any value out of the show, to do so. And hopefully it doesn't disappear after a week or two. But anyways, I'm still at it, trying to get back to that 100, and also just trying to provide you with a lot of value in these episodes, especially these solo ones. I kind of kick myself sometimes. I'll record an episode and not think it's good enough. Sometimes I don't even want to publish it. I guess that's me being a little bit of a perfectionist, but I just really want to give you guys value. I'm not here just to hit record and listen to myself talk. I actually want to provide value to those that actually take time out of their day to listen, because I know how that is. I hate when I take time to listen to a podcast and it's not really what I thought it was going to be. So I hope I'm actually providing you value. In today's episode, I want to talk about something that I think is valuable, especially in today's kind of climate, and that's underwriting, and kind of what you should be doing, kind of rules of thumbs of the current times we're in, how you should stress test, maybe where you should be really conservative. Really, when I say conservative, it's more of just making a very educated assumption, right? Based on, your experience, based on kind of like a gut feeling, but more so just based on all the external factors, and putting those together and making a really great judgment on where you think things are going. So that's what I mean when I say conservative. It's not just, hey, I'm just being, super conservative in the sense of just taking it easy and not trying to overstep or make any crazy assumptions. No, when I say conservative, I just mean I'm putting in the work, doing the research based off of my experience, based off of external factors. I'm making decisions that I think are most likely to happen. So and I'm not making an optimistic decision or a pessimistic. It's what I think is going to happen. Then I get into more. We have a whole stress test analysis on our model. As we call it sensitivity analysis, where we'll give ranges based on certain increments we can put it at. So if we're looking at vacancy, we're looking at rent growth, looking at exit cap, amongst other things, we can because those are some of the biggest levers, right, that are going to really move the needle on what can make a deal work or not. So we'll kind of have a sensitivity analysis. So say for vacancy, if that goes up by 50 basis points or 100 basis points per year, we will put those in different increments going up or down, right? So let's say year 4, you're underwriting at a 6. What if it goes up to 7.5, 8? Or what if it goes down to 4, 4.5? Obviously that'd be great, but we just want to see where the IRR is going to be, the average cash on cash, and the average annual return. We want to see where those kind of move. And then usually we have a base case where we think it's going to be. But I just wanted to jump into some of the rules of thumb and different inputs you should be taking into account, and where things kind of stand based on my experience, other individuals I've talked to that have a lot of experience as well, and kind of how to navigate these rough waters. So first, everyone's going to be like, rates, right? That's obviously the big thing that is moving, is constantly moving, it seems. And as I always say, the best thing to track is the 10-year treasury. That's where all lenders kind of, base rates off of, is what is the 10-year doing. So for instance, right now, as I'm reading this, it's at 3.239. And last week, or over the last couple of weeks, it's taken a huge jump, especially after the Fed announced the 75 basis point hike. So if we look at that, beginning of the month, it was sub 3%, and then it went all the way up to almost 3.5%, and now it's at that 3.2, 3.3 range. So lenders are really going to be looking at this, and so what I would highly recommend, if you don't already have a solid, lending partner, this is what we do, is we utilize their research, right? We talk to multiple. Where would you underwrite your deals at right now? Because obviously, when you're doing preliminary underwriting, you're not going to necessarily have a solid quote, right, from a lender. So I like to know what range I should be underwriting rates at, and then if it's a solid deal, we dig into it, and then eventually we submit, for more solid quotes from our lenders. So right now, I wouldn't, just to be safe, I wouldn't be underwriting probably under 6% for a rate. Obviously, it depends on what you're doing. Are you doing floating? It's going to be obviously less, and you're going to want to pay, a cap on that. But if it's fixed, I wouldn't necessarily be doing anything less than 6, unless you can get agency, which agencies probably are anywhere from 5.2 to 5.5 right now, depending on obviously your LTV, your LTC. Mostly, you're probably only going to be able to get 60 to 65% LTV, loan to value. And I think that's appropriate for these times. I would not want to over leverage right now. So we're writing at either the 65 to 60% LTV. Generally, assume just when we're doing a first underwriting, anywhere from 5.5 to 6%. I would say probably 6 right now. Things have started to retreat a little bit, so you could go sub 6 as we get more information. So that's kind of the rate. And in terms of what you should be doing, whether it's fixed or not, it really all depends on what your plan is for the said deal you're looking at. Now, if it's for a longer hold, maybe you do fix, but you also want to know what any yield maintenance that there might be, or defeasance. And what simply that is like, what do you have to pay to exit the debt before the term ends? So say you want to go and maybe rates lower, and you either want to refinance a lower rate, or maybe you want to sell. You want to make sure, what are those defeasance? What is the yield maintenance there you have to pay? Because it could be high enough where it doesn't make, it would actually be a detriment to the deal. So in those circumstances, it might make more sense to not do a long term and do more of a short term floating rate with a cap on it, and then either be able to sell or refinance into something, refinance into perm debt later down the road. I know most people beat the drum, get fixed. Obviously, yes and no. All depends on the circumstance. All right. So in terms of assumptions, we all know inflation's here, right? And clearly it's not slowing down. We hit a new high in the month of May, 8.6%. So with that, what you want to be doing is anything that is going to be affected by inflation. So utilities, office admin, repairs and maintenance to an aspect, payroll, trash, water, sewer, all those utilities, even insurance. Insurance is going up, but that's for another reason. And even taxes. All those things you want to take into account how inflation can affect those. Specifically, the items I mentioned before, taxes, insurance. I would want to add at least 10% to what the T12, so what the income statement is giving you. And then from there on, you can do, your traditional expense growth. But I would want to add at least 10% to what they're saying it is now, just because things are going up. And you could even, maybe add 5 to 8% for the next year, and then go to your normal 2 to 3. But I definitely would want to do that. I wouldn't just keep these things like payroll, utilities. I wouldn't just keep those, flat as they are now, because they are going to bump up. And in terms of payroll, you're definitely going to want to bump that up, because it's getting harder and harder to find people. Trust me. One of our properties, we had to let someone go, and we had to hire, and it took us a while. Luckily, we have found someone, but it took us a while, and we had to pay, more than we were paying before. Not by much, but it's still a little. And so you got to take that into account. So unless it's some crazy out of whack, maybe they have family members working there, they're just paying them a crazy amount of money. Unless like that type of circumstance, I would go higher than what they're paying now. If you truly know what that payroll is just for the staff they have on site, and also if you agree that the number of staff they have there is adequate, right? If it's too many, then yeah, you could dial it back. But if it's the correct amount, then I would still underwrite at a higher payroll than they are, because it's people just don't want to work for whatever reason, and it's getting harder and harder to hire people. So you have to incentivize them, obviously, with a higher pay, especially if you're going to take someone from another property. So I would definitely be looking at that, by increasing that. Now I'm just looking at, so this might seem like it's out of whack. I'm just looking at my model. And so reserves per door, I would definitely do at least 300. Your lender is going to tell you what you should be doing as well, because that's who wants it. And it's a combination. You have insurance reserves, and then you also have, they make you put in escrow reserves for your debt as well, and taxes sometimes. So $300 per door, I think, is adequate. It used to be around $250, but $300 now I feel is a good number to be underwriting at. And then when it comes to taxes are definitely going up. So this is something you want to dig into. This is not something where you just go, oh, I think it might go up 20, 30, 40, maybe even 50%. Now, this is something you really want to dig into, because one, it's going to change per market, and it's even can change per county. So you really want to dig into this. And so you're just going to go to the counties or the state's website, and you're going to figure out how they calculate it. So the deal I'm looking at on my model right now, you take the market value, so which would be the acquisition price, so your strike price. And then you're going to we usually take 85% of that value. For a while we were doing 80%, but things have gotten more expensive. So now we're taking 85% of that value, and then you factor in a ratio. So for this one, it's 6%, but I know in places where we invest in Georgia, it's 40%. So then you take that strike price, multiply it by 85%, and then multiply it by that ratio. In this instance, it's 6%. It's going to give you an assessed value. So here, that assessed value is 1.1 million, and then you're going to use a county rate. And that county rate, in this instance, is 446.9999. You're going to multiply those two together, and that's going to give you your tax burden. So in this instance, the tax on this property in year 2 will be $495,834. That's an increase of 39%, which isn't terrible. I've seen increases, especially if you're buying something older, which always take this into account. When someone's pitching a deal, it's owned by the original builder, owned it for 40 years. Just know, well, there's going to be in most counties, in most states, there's going to be a huge tax increase. So I've seen it upwards of 400% increase. So that's important, because that can kill a deal, that cash flow in year 2. So make sure you're dialing into that. We'll even just call call the assessor's office and ask them, like, we did this calculation. This is what we got. Is this safe to assume? And they'll tell you yes or no. Really that easy. And then for your Capex, I was talking about with salaries, repairs and maintenance, utilities, all that stuff, it's going to cost more. Well, guess what? Same thing with Capex, because we're buying materials and also labor. It's all gone up. So what you normally quoted, maybe you were good with getting away with 8,000-9,000 per door to do a good sized renovation, right? Honestly, if you're doing a decent sized lift, obviously not a full reposition, but a decent sized renovation, reposition, I wouldn't go any lower than really 10,000 a door at this point. Just because, one, materials have definitely gone through the roof, things that have gone up 50, 80, 100%. And then also labor. It's getting harder to find people, one, and then two, if you do find them, they're gonna charge you more. So I would definitely be underwriting at a higher Capex than you normally do. And it also all depends what you're doing, right? So how we break it down in our model is we have, for interior, we do a classic Capex and we do a premium Capex. And obviously those are going to be at different rates. So it all depends what portion of the units you're going to make premium and what portion you're going to make like a classic upgrade, because you'll need to bring more Capex if that ratio is heavily to the premium side. All right. And then for insurance, definitely want to get quotes on insurance as quickly as possible. Insurance is going up like crazy. Like, for instance, on this property, it's currently $379 a door for insurance, and we're underwriting $425. And it could be a little more, but it might be a little less. But we've talked to our provider, and they're comfortable with that number. But it's going up, right? So everything's going up. So you just need to be very on point with these things and check, double check, triple check, get as many quotes as you can. Obviously, as more you dig in, you don't need to be getting multiple quotes right out of the gate, because you want to see if the deal works first. But once it does, that's when you want to get multiple quotes and see where you stand. And I touched on debt and equity. Just don't over leverage yourself. Please don't. And write at a higher rate than you may think you can get, just to be safe. Because even if you say, you can get like a 5.3 to 5.5% rate today, right? You might be able to. The next time they raise rates, that might be over 6. And I've seen this happen to people where they're under contract, the deal works, and then 60 days later, when they're getting close to close, rates have gone up once, maybe even twice, and now the deal doesn't look so good. So in the current environment, I would underwrite at a higher rate than you can get right now. If it works, great. If it doesn't, then at this point, there's no point of forcing anything. There's going to be so many deals that are going to come to the market. They're going to be great opportunities because of what's going on, and people are going to be forced to exit for one reason or another. So don't feel pressured that you have to get into something today or tomorrow. Just wait. I know patience is tough, but it pays off. Trust me. All right. Now, in terms of on the debt side, when I was talking about, what your loan to value, your LTV should be. Now, that's going to be based off of two primary things. They take a lot into account, don't get me wrong, when they do a deep dive and when they do their own underwriting. But when they first look at it, it's primarily two things. And that's your DCR, your debt coverage ratio, also known as DSCR, your debt service coverage ratio, and your debt yield. So what those two things are, so your DCR, your debt coverage ratio, that's comparing your NOI to your annual debt service. So your net operating income. So on this property, when it's stabilized, we're looking at a 1.2 million NOI, 1.26, and we're looking at our debt service of 777,000. So they want to see, and that puts that DCR is 1.55. But on year one, if we look at it, we haven't stabilized. NOI is at 953,000, and that debt service is going to another powerful tool of why you use leverage, because it's based on today's dollar, not a future inflationary dollar. It's going to stay the same. So it's, yes, 777,000, but that puts your DCR at 1.17 for year one. And they want to see year one DCR of at least 1.25. Some even higher, but usually for the agency of the world, it's about a 1.25. Bridge debt, they'll look less. But if you're looking for something more fixed, permanent, like an agency, it's 1.25. And now debt yield, they also look at. And what debt yield is, that compares the NOI to the overall outstanding debt you have. So obviously that number decreases over time because you're paying interest and principal down. And so they want to see it. Last I checked, it was 7 to 8%. And it all depends on vintage, right? So if you're getting into your C class and some Bs, they're probably going to be more towards the 8 to 8.5 side. Whereas if you get some, higher quality, newer assets, they're going to be more towards that 7, that lower end of the range. So for this, for instance, is 6.7% on year one. So that's a little low, right? It is higher quality, right? It's a newer build. Then at year two, it does jump up to 9. And it gets all the way up to 11, which is great. So if we were to refi on this one, on that year 3 at 11.7%, that's a great debt yield, and it has a DCR of 2. So not only do you want to look at what it is on year one, you also want to look at what it would be if you're going to, if in fact your business plan calls for a refi, what it would be at that time. And at this point, that's a phenomenal debt yield and DCR. And then also, well, what should I be underwriting my rate at, right, in 2 to 3 years? What I would say, it's very up in the air, because where are we going to be, right? The bond market right now, the forward-looking curve projects rates to increase until throughout 2023 and then peel back beginning of 2024. So at this point, in 3 years, that's 2025, or 2 years, 2024, you might start getting some peeling back. But I would be underwriting, if you were to refi, at least 100 basis points increase on your rate. And that's just to be safe. I'm not saying that's where it's going to be, but you need to be protecting yourself, and especially protecting your investor capital. So that's what we do. So those are the two things you really want to be looking at: the DCR and the debt yield, and that will let you know where you're going in LTV will probably have to be. So for instance, on this one, we currently have it at 35. So if I changed it to 40%, so that would be a 60% LTV. Now I look at it, and there we are, 1.26 DCR and 7.3% debt yield on year one. Now that would work. Obviously, what does that do? That increases your down payment and more money you have to bring to the table. In this circumstance, it only increased by $1 million. It's not too crazy, but still, $1 million's $1 million, right? You got to take that into account, which is going to also dilute some of your returns, right? Because leverage is your friend, but it also can be your enemy. In this circumstance, where rates are rising, there's a lot of inflation. It also can be your enemy. So it's kind of like the give or take. Before I end, I want to talk about that sensitivity I was telling you about. So what we do is we stress test. We look at break even. What's it going to take to get us to break even from, vacancy, including, delinquency, because that's the big thing we got to look at. A lot of people are pushing rent growth right now with inflation, which I get, right? Fundamentally, historically, when there is inflation, there is rent growth. And over the last 30 years, 30, 40 years, we've averaged 8.5% rent growth, which is phenomenal. But when we're seeing 20% rent growth in a year over year in some markets, it gets to a point of affordability, especially if you're investing in B and C class properties. those are people that are getting choked the most by what's going on in the world with, inflation, energy prices. And, it gets to a point where some people, especially if you're investing in C class, where they have to make a decision between pay my rent or put food on the table for me and my family. And we all know what they're going to pick. They need to eat, and I don't blame them. They need to feed their family. And so then the rent's going to suffer. Our delinquencies as owners, operators is going to increase. Collections are going to go down, delinquencies go up, and that can kill a deal, especially in times like this where people are getting pinched. So we like to stress test that and see how high delinquencies could go before we start losing money. Because for anything, it's about preservation of capital. It's return of capital before return on capital. We're stewards of our investors' money, and we aim everything to protect that hard-earned money before all else. So that's why we stress test these things. We want to see, how far we can push that rent growth and how far it could go without any rent growth. Where we can push vacancy and then our exit cap, right? That's one of the biggest levers. And, over the last, 4 or 5 years, especially the last 2 years, cap rates have been compressing a lot and rapidly. However, we've seen a little correction, and in some markets I've seen, cap rates grow a little bit. They've stopped compressing and have actually grown. Now, what I think is going to happen is there's a lot of volatility in the market, so some money has kind of pulled away to let the dust settle and assess. And so people who still want to sell, they're having to drop their price, so cap rates are increasing. What's going to happen is once the volatility has kind of gone away, dust is settled, the money's going to flood back in. Because we all know this is one of the best places to put your money. Historically, it's been one of the safer places to put your money and to grow your money, to provide yourself not only yield, but appreciation and tax benefits. I don't know any other asset that does all that like real estate does. So the money's going to flow back, and when that does, caps are going to compress. So Shawn, well, where should I be underwriting my exit cap if I buy a property today and exit in 5 years? Well, I still increase the cap. I never underwrite where I'm decreasing the cap, because a lot of things can happen. And if you don't hit that, that's one of the biggest levers you can play with. So if you're decreasing your cap on the exit, it may make your deal look killer, like 19%, average annual return, 20% average annual return. But if you don't hit that and it actually increases by 100 basis points, 150 basis points, you could potentially blow up the deal. Not that you're going to lose money, but it's not going to be anywhere near those type of returns. And it could even be where you could even lose money if it goes up too much, for sure. So you got to be really careful with that. And so historically what we've done is anywhere from 5 to 10 basis points a year increase. So over 5 years, say it was 10 basis points, you're talking about 50 basis points, so 0.5%. But in times like this, you might want to push it even more, closer to that 100 basis point increase over 5 years. Now, I'm not saying that's where it's going to be, and most likely won't, but it could. And that's why you have to underwrite like that. Because what if it does? There's obviously no surety in life. If I had to bet on it, I would bet that it wouldn't go up like that, that they'd be around where they are now, maybe even compressed a little bit. But I don't gamble other people's money. I don't gamble my money that I invest like that. So I'm going to increase it. And I urge you do the same. All right, everybody. I think that pretty much does it. Obviously, if you have any questions, there's a lot I could go over about underwriting. And I plan on bringing my partner, Tucker, on for an episode. He does majority of our underwriting, one of those Excel gurus. And we're just going to do a deep dive into how we actually underwrite from start to complete. I think that'll be a great episode. But in the meantime, if you have any questions, you all know how to find me. Instagram and LinkedIn are probably the two best ways to get in touch. LinkedIn, it's at Shawn Wins, and LinkedIn, just search Shawn Winslow and you'll find me. All right, everybody. Thank you for tuning in as always. As I mentioned at the beginning of the show, if you haven't left a rating or review, please do so. It would mean a lot. I don't know what's going on with Apple Podcasts, but we've lost almost 30 ratings and reviews. So it'd be great if you haven't done so and you found value from the show to leave a rating review. I would greatly appreciate that. All right, everyone. As always, thank you for your time. I'll catch you on the next one.
Hey, this is Shawn Winslow. After being in the financial service industry for years and having candid conversations with good people just like you, I realized that so many of us are wanting an investment strategy that provides solid returns and consistent income without the bumps in the road. There's little known secret that your financial advisor doesn't want you to know. There is investment out there that is less volatile and the returns are stronger. Get more details by going to greenbriercg.com and clicking on the free e-report. And by the way, if this show has provided you any value, then feel free to leave an honest written review and of course, share it with a friend who needs it. See you next week for another great show.